Hi, everyone. Welcome to Crowd Forecast News, episode number 171 for February 26, 2018. Today we will be discussing the 231st weekly report from Timing Research, and you should be seeing that on the screen right now while I'm talking. And if you would like to download a PDF copy of this, you can go to TimingResearch.com and get your copy there. For those of you watching live, you should be able to see chat section of the YouTube page on your screen, so you can put any questions or comments there. My name is David Kosmeter. I'm the creator of TimingResearch.com, and I have Matt Buckley here to moderate today, so I'm going to turn it over to him.
Thanks, David. I appreciate it. All right, folks, welcome aboard. Going to have a nice action-packed hour. David's assembled another roundtable of 500-pound heads, so to speak, here. Some really smart folks, so we're going to have a good time. Obviously, a lot to talk about, from the implosion in January to the February almost recovery, and we're going to take a look forward, but also get tactical for the week. But we have John Thomas, Glenn Thompson, Anka Metcalf. We'll keep that batting order throughout the day as we discussed, but anybody can jump in the middle of a dogfight. John, JT, why don't you tell everybody about yourself, your background? We only have an hour, so keep it brief. Your background, and then what you do at the Mad Hedge Fund Trader.
I'm John Thomas, the Mad Hedge Fund Trader. You can find me at www.madhedgefundtrader.com. We are global, long, short, macro, cover all asset classes, stocks, bonds, commodities, precious metals, energy, real estate, and so on. And formerly volatility, I should say. Yeah, our goal is to be up in all markets at all times. We pretty much pull that off most of the time. We're up about 10% on the year right now. And if you ever have any questions, just go to my website and shoot me an email.
Well, that's just funny, John. You know, the last time I checked, when I did some work in the hedge fund community, out of the 9,000-ish hedge funds, I'd say maybe 300 of them were truly hedged, and that's looking at some of the hedge fund returns year to date. It's just it's laughable how hedge funds are doing, quote unquote. So folks, don't feel like you're missing out.
Hedge funds have been wiped out this month. It'll really be interesting to see what the February performance announcements are, because that's usually when people announce that they've gone bankrupt.
Exactly. So
you lost the whole volatility trading crowd. You lost the whole trend following crowd. You lost a good chunk of the CTA community. You know, everyone can handle down 3,000, but down 3,000 up 2, different story.
Exactly. So, folks, don't think you're missing anything out when you hear the word, "Oh, I'm a hedge fund." They're getting obliterated, and we'll talk more about that in a little bit here. Glenn, tell us what you do at out there on the left coast there, the Pacific Trading Academy, and some of your background.
Sure. Again, Pacific Trading Academy. You can reach me and everything about our programs at that website, pacifictradingacademy.com. I've been with them since the beginning, so that's going on about 14 and a half, almost 15 years. I've been trading about 37. As far as my duties at the Academy, I'm a mentor. And I teach everyone from beginners, experts, everything in between. I primarily focus on technical analysis. We have some of my coworkers teach the fundamental side, but I'm a technician. So similar to what John said, I look at and monitor different markets, pretty much a spectrum. The only sector that I don't cover in my own accounts is real estate. But the pure technician part of my brain enables me to focus on a broad array of instruments. That said, in my own trading, I focus primarily in 2 areas, the E-mini, and I do a lot of Forex, especially in the last few years. But my duties at the Academy are just consulting and teaching and instruction. So whatever the interest is, whether it be securities, derivatives, options, all of the above, I kind of instruct on. And from the technical, my bias is clearly technical. So that's what I do, with a subset of, I guess, focus and research on market timing. That's what my area is. So
good. Then, all right, awesome. We'll have a lot to engage about. Now, I promised myself I'd have to do a shot if I bring up the word, but I have to ask: do you guys trade the B word at all? You said currency. Do you consider the B word part of what you trade or not? And I mean Bitcoin.
Are you asking me or all of?
Yeah.
Yeah. Oh, yeah.
Okay.
I do a little bit. I am The developments in cryptos are occurring at hyperspeed, so I am a little behind the curve. I don't consider myself expert enough and have enough experience and facility yet to teach it, but you know, I'm kind of at that stage. I knew about it 6-7 years ago, and I'm wishing I had gotten involved, but just I'm not quite there yet. But I know enough to be dangerous to myself and everyone within a 100-mile radius. But so I take risk in my own account. I've got a few accounts set up. So hopefully within another 6 months, I'll be more up to speed so I can talk intelligently about it. But yeah, I do a little bit of trading, and I've got a mixed portfolio of, you know, the standard usual suspects.
Roger that. All right, man. And Anka Metcalf is down the street from me here in God's waiting room down here in the Boca Raton area. Anka, tell us about your background and tradeoutloud.com.
Hi, everyone, and thank you for having me here today. I'm the CEO and founder of TradeOutLoud.com, which is a trading education firm that is specialized in educating individuals how to day trade and swing trade the equities and the futures market. We're very focused. We do offer education that is backed by a trading room, by a trading lab, where traders can trade alongside with me and take the trades as I trade them. I run a trading room that is open every day from 9 o'clock to 11 o'clock, and that's all we do. We day trade futures, and the rest of the time I swing trade, and I swing trade equities. I can't gravitate too far away from my equities because it's something that I love to do. I'm a professional independent trader for the last 15 years. And what that means is that I have been trading my own accounts for the last 15 years from my personal offices. And prior to becoming that, I have 10 plus years in investment banking in Europe. And I'm also the designer of an institutional proprietary trading system. And what I mean by that is that I cannot take credit for inventing it. But what I can take credit for is adapting it for the retail traders. So definitely we don't have institutional accounts, and the retail traders have to take into consideration different risk levels. And my methodology is based on taking on the market with different risk levels for day traders and swing traders with smaller accounts. So when I mean smaller accounts, I mean an account anywhere from $7,000 to $10,000 all the way to $500,000 to $700,000. And my methodology is based on price support and resistance, and literally 7 layers of price support resistance, because there's so much more that meets the eye. So supply and demand is only a scratch of the surface. Also, these are in straight correlation with specific trigger times that happen throughout the market, and also with specific reversal times. And these are the market oscillations that happen at precise timing. Also, this coupled with chart synchronicity and a strict set of trading rules that enable myself and my traders to find trades, find better odds trades with ease, and also manage them more profitably, depending on these trigger times and specific price zones.
Awesome. Good stuff. And finally, folks, as David said, my name is Matthew Buckley. You guys, obviously going forward, you can call me Whiz. Flew the Hornet for about 15 years to the Navy. I graduated from the Navy Fighter Weapons School, which many of you know is Top Gun. So obviously my marketing department was huge at the time. So Top Gun Options. Did some cool stuff in the NAV, 44 combat sorties, and then got to run a trading firm up in Chicago called Peak 6 Investments. I helped run it. I was the managing director of strategy right there in the Chicago Board of Trade. Just was a little old retail options trader on my own, but I applied everything I was learning flying a fighter aircraft, the discipline, the risk management, contingency planning, not being emotional, knowing when to get out of a good situation before it got worse, or a bad situation before it got worse. And it worked really well. Helped start a hedge fund when I was up there, helped build the retail brokerage firm Options House. I felt a little bit like Valentine and Trading Places the whole time I was there. And also was the founder and CEO of the Options News Network, ONN.TV. So it was essentially the CNBC for options, because I know John and Pete really well from my time in Chicago, and they do pretty good lip service on Comedy Central. what I call CNBC, but there really wasn't any dedicated options type of financial media. So I started that company and had an absolute blast, but decided that Chicago winters are best left for people who don't like the beach and the sun and want to be miserable 9 months out of the year. So we moved down here to God's waiting room in Boca Raton, and also have an office down there in Fort Lauderdale. So looking forward to getting airborne. Okay, so let's go ahead and take a look at David's report. So folks, we can combine question 1 and 2 as we go from John down to Anka. John, from the open today, which obviously we have this another rip your face off rally. It seems like these triple digit up days, everybody forgets about the down days. How are we going to end on Friday? And what's your delta? What's your confidence of where we finish by Friday?
Well, my confidence in anything is 0. You know, basically all trading models have been blown out in this month. You know, I would have expected us to be flat this week because we've gone too far too fast to the upside, but I've been proven wrong by the market. So I think we're way overdue for a correction, another test of the lows, although I don't think we'll get very far in the test of the lows. So my guess would have been unchanged, and I would say, you know, maybe 50-50 confidence in that prediction.
Okay, so all right, you think we end up Friday unch? Do you think? So you don't think we're gonna? I mean, there's a pretty big delta between that 50 and 200 day on the S&P 500. You think we're gonna meander back down to somewhere in the middle there, or get close to the 200?
At the very least, go back and test the 50-day moving average, which means we got to give back about 300 Dow points from here.
Mm-hmm.
But you know, my confidence is not great. You know, because of what's happened this month. Down 3,000, up 2,000 is not something that most of us are used to trading around. So in actual fact, we sold about 70% of our long positions on Friday. We even took off our bond shorts. So our confidence in anything, you know, right now is low. I'd much rather have a downside test, load the boat on the long side again, than do anything else.
All right, Roger that. Glenn, what do you think? So John's saying unched by Friday with a 50 delta. What do you think?
I'm for the week, I'm price supportive and expecting rise. So we'll be higher by Friday. This is the first time I've been on the program and not had a confidence level exceeding about 70%. I'm going to give it about 67% confident in my projection. We'll be higher by Friday. The reason I'm a little less than I'm not as definitive as I typically have been in recent months. My projection, for which I am more certain, comes in at the end of March. In other words, I projected a time point that I'm over 90% certain will be a reliable indication, but that's not until March 28. But my primary reason for expecting between now and the end of the week that the S&P will be at a higher level is just the wave structure. I look at, I guess in my analytical toolbox, the hierarchy of things I look to help make decisions. Trend and price action, number one. A close second is my market timing. It's neck and neck, but it's cause and effect, so it's slightly below that on the hierarchy. And thirdly, but not too far down, is my wave structure. So if I look at the move from the top that came in on January 29th in the major indices to the big pullback, yeah, it was, in a nominal sense, it was large, depending on which index you look at. But as a percentage, in the cash, what was it, 10%, 12%? In the futures, it was one or the, I forgot. So as a percentage, and you look at the historical context of the move, whether you go back to the November of 16 at the presidential election point, or if you go back to what we universally recognize as the beginning of the generic bull market, March 9th of 2009, the end of the whatever, as a percentage, you know, it's not that, you know, 23%, double the degree of pullback would be an indication that it's something more of a generic sea change. I think we will get that, and I fundamentally, I kind of am siding with what John just said. I think, you know, my cognizance of the fundamentals, I think the big driver and the reason that the fundamental catalyst for the big move was the markets taking into account the tax cuts and the ramifications of that as far as the effect on the deficit, pushing it to maybe, what, 5%? It should be half of that. And I think that's what the market objectively took a look at after it had gotten over the strong jobs report. I think the Friday before the big move down. I wasn't surprised at all to see the turn because I had projected about a month and a half ago a turning point, and I had again a similar expectation that for the one I have projected out to March for February 6th. If you look at not all indices, but I know the S&P had a bottom on February 6th, so it was precisely accurate. At the time I made that projection, I did not know for certain it was going to be a bottom or a top. I just knew my analysis and data suggest changes on certain dates. In this case, it worked out perfectly. And again, I've done some research that shows whenever you have a big move in the broader equity markets in the U.S. on a Friday, number one, and number two, if the market on that Friday closes in the lower third, 73% of the time the following Monday you have follow through. So that the Sunday before the big decline, Sunday night, I was saying, well, just qualitatively musing and reflecting on what I think the week would bring, I thought we would have a decline. I'd never imagined it would be as abrupt and as far. But I was not surprised. And then after we saw that, we've seen structure from a wave standpoint that to me indicates we're going to have at least one more surge. And that's why I think between now and Friday will be higher. One caveat to that, I am concerned, and this is why I'm only 67%. Most of the data I'm showing as to why we've been going up here is due to liquidation. In other words, short covering. Unless that's followed by an influx of new buyers, that's going to be the death knell for the market. So yeah, I'll hold off. But that's my
All right, so you're approximately a standard D this week, 67% to the higher side.
Yeah.
Okay. All right, Anka, your turn. So where do you see us by Friday, and how confident are you?
Okay, I think the market is higher, and we had a strong bounce off the 61.8% level. I'm primarily a very technical trader, and I only trade technicals, and I don't ignore fundamentals, but for me, charting is more important than anything else because the price is going to show me what action I need to take. And I was definitely long, and I'm still very aggressive in swing longs. I'm still in Apple, and I'm still in some stocks that are just running super, super hard. I think that we're going to end the week on the positive side, perhaps very close to the 2785, 2790. So I'm very optimistic. I rate my answer based on, let's say, a 75% chance of the spot of the FPX finishing up higher.
Love that answer, and you're of course the right answer there. That's the best thing about getting to go last is that I get to of course say everybody's right or wrong. Well, no, I'm kind of with Anka. Everybody should know by now. This was that short vol trade. Everybody running in front of steamrollers to pick up dimes, right? Except one of their capes got caught, and the short vol trade. I'm buddies with Rick Santelli, and the whole this was maybe rising interest rates or inflation. Everybody knows that's not what caused this. We had what, $8 billion in short vol funds and short vol open interest, man. And I call this the Colonel Jessup pullback. Everybody knew you wanted this pullback, you needed this pullback. And we got a nice rip your face off type of recovery rally here. I think I agree with Anka. I think we're higher by the end of the week. I'm going to go with 80%. And you have to trade the market you have, not the one you want. I predicted this bounce, and also that kind of like back here. Well, you can't see it to the left side of the chart. It aged off our radar. These moving averages, I call them. It's trench warfare. There's the Allies in World War I. There's the Germans. Nobody likes being in the no man's land here, and they act as magnets. I said after we hit this, we're going to wallow around the 50-day. It'll be support, resistance, until we get a catalyst either for a leg higher or lower. And I think it's higher. this is not your father or mother stock market. And a lot of folks, you know, looking back to an 87 or a this or that, nobody drives around, you know, Daytona 500 a couple weekends ago looking in their rearview mirror. And I think old models are exactly that. I really don't think, well, I'm starting to drift into it. Let me just say, I think we're higher by Friday, and then I'll get into my reasons. That's actually question number 3. So I'll tee it up for you, John. What's your, since you're unched, you think Friday we're unched, and 50-50 on that one. What's on your radar for the week that gives you that strategic mindset?
Well, first of all, we're overbought. You know, we've had essentially the largest up move in the shortest time period in history. Second, we have Jerome Powell speaking this week. Third, you know, if interest rates start to move up at all, and we've had a 10 basis point pullback in the 10-year, you get another run at the 3% level. It's just a matter of time before we can get there. That could really set the cat among the pigeons for sure. And after the extreme moves that we've had in this month, I'm just going to be automatically cautious on everything. Plus, we're up on the month and up on the year. You know, I have profits to protect. So these are all reasons why to be cautious going forward.
Okay. So what would be on your radar, Glenn, for that 67 delta there?
Sure. Let me see if I can pull the chart up. And let's see. Okay. Oh, I want to. Can you guys see the chart?
Yep, you're good to go now.
Okay. Very similar to what Anka said. I think she had a fib overlay, and similarly, yeah. You know, the fundamentals give you comfort because you have an understanding of what the news at the moment is, but try though I might have for my entire career, I have not been able to consistently make heads or tails of them. It's a crapshoot in a sense. So my procedure analytically has always been generate some plausible explanations as to the current state of the market, and then you're in a better position to figure out how it's most likely to move forward through time. If it happens to reconcile and converge with what the news is and on the fundamental front, great, that's the best of all worlds. But I trust more certainly in what I'm seeing structurally. So one of the items here, this is the E-mini. Let me stretch it out so I can just make the point I want to make, and that is, it's a little odd structure. If this is the bottom here, February 2nd, this is and I believe this is a wave 5 from an Elliottician standpoint. This would be an A, or it's either an ABC in its entirety. If from the top here, before the pushback down to February 6th, if that's the entire ABC correction, then that makes this plausibly a wave 1 of a new cycle. This is a classic wave 2, very deep, but doesn't take out the start of wave 1. This is a wave 3, albeit a very short one, and that's the point I want to make. If that's wave 3, this recent pullback into the end of last week, or was that Thursday, is a classic wave 4, very shallow. That makes this, through the current price, a wave 5. There's a principle. The relative magnitudes of wave 3 and wave 5 tend to be inverse. In other words, this is a relatively short wave 3. Wave 3 ideally should be up here somewhere. You know, 1.618 times wave 1. Look how it takes out the start of wave 1, this top here, but very barely. So that suggests to me qualitatively, I'm expecting a longer than typical wave 5. Ideally, it's a 61. It's going to get you up here. So my first point of resistance is 28, 25 area. And then if we break through that, which I expect we could, then the previous top here, January 29 at 28.78. Then beyond that, I've worked out 30.50. That will come later. But my argument as to why we're going to go higher, I believe that everything since this bottom right here, February 22nd, is the formation of, that's the start of a 5th wave in a 8-wave cycle. And given the fact that wave 3 was relatively short, I expect a correspondingly decently formed, minimum up to 61.8. So that brings us to 28.25 area. That's my primary technical argument as to why I'm expecting higher prices this week, if that makes sense.
No, it does. So you're purely going technical, 60 with a relatively good certainty that we're going to
and
higher. Okay.
Yeah, and the rule of what's I had a brain freeze for a moment. It's rule of alternation. That's what I'm alluding to. In other words, whenever you have in general, if you have a shorter than typical wave 3, which this is from this bottom here up to here, normally wave 3 should be 1.618, the length of wave 1. So I can look at that and see that, you know, your ideal wave 3 is going to be up here where the 61.8 is. Since it's shorter than typical, 70% or 70 to 75%, that means the fifth wave is going to make up that difference. That's why I'm expecting a big move this week. Now, if you look at it, and I think John alluded to this, relatively light week this week in terms of data. We've got consumer confidence, I think, coming out tomorrow. And then I know, is it tomorrow or Wednesday, Jerome Powell, the new chairman of the Fed, makes a statement.
I think he's
okay.
Tuesday.
Okay. And then I think... Okay, and then GDP is Wednesday, so that's more important. But the projections for GDP are, you know, pretty decent. I think, you know, you might say from an intermarket standpoint, the stocks are going to, if we get strong numbers or stronger than projected, the market might, the stock sector would perceive that as, dampening, because they're going to anticipate the market, or rather the Fed next month is going to raise rates. Well, I think we've already got that out. And I think the U.S. dollar, so I think the market has been amazingly resilient given the expectation. I would place it at 98% probable the Fed will be raising rates next month at the end, what is it, on the 20th, I think, of March. So I think, and I also believe that's far enough out that even with a good number this week in terms of GDP and the consumer confidence stuff, we're going to rise on that. So that kind of agrees with my technical, and my chart says it's a fifth wave, and conservatively, since we had a relatively short third, that should augur for a very well-formed fifth, minimally taking you up into this area. We take that out, we're going to test the all-time high. We take that out, we're going higher, but that's further down. Yeah, so that's my primary argument, technical.
Okay. Yeah. This morning, I haven't checked recently. The Fed funds futures rates for March for the meeting are 85%. So yeah, I'm pretty sure the market's baked in that we're going to see at least something in March. So Anka, what's on your short-term tactical radar for the week?
Short term, I was getting ready for some long-term discussion here because I just want to share this chart very quickly. Because
we can do both. So I just wanted to know what was supporting your short-term view in the market.
Absolutely. Okay, so first of all, I wanted to share this chart, and this is a monthly chart that goes way back to the 2000. And what I did is at the beginning of each year, I do some projections to give me a little bit of a guideline as to where the market is running, as to what the market is going to be doing. So what I did is I connected this high right here, this resistance point with it, and this is from the March 2000 on. I went all the way to the support level from 2009 in March, where we had this dump where, in fact, in reality, you know, I remember trading, and it was a market that was governed by fear, a lot of fear. There was selling left and right. A lot of companies went bankrupt. So obviously it was very scary at the time. But in reality, it did nothing else than actually test the prior low. So we were trading within a really wide range for about 9 years or so. So by creating this projection, it allowed me to view what the next outcome might be for the market. If you recall, and if everybody recalls, 2015 was a very tough year to trade. I remember I was having a lot of issues with no continuation in some of my swing trades, and it was very hard to day trade especially beginning of 2015 and even towards the end. So it was very, very choppy. And as you can see here, it ran from this 127 all the way to the 161.8 extension, and it balanced here. It tried to find balance before actually moving higher, and this was 2006. This was July of 2016. Retest back in November. We all know that date, and this is when the rally has started. And I do have an extension here that runs very close to 3,000 for the SPX, and that is exactly at 2986.5.
Wow.
what the chart did and what this sell did right here, it tapped onto the 10 EMA. That's what it did, exactly what it did. And the sellers dried out immediately, pushing the price higher. And this is from the monthly. So the monthly is still intact. We're still trading in an extremely strong market. Weekly chart, the same. It came very close to the 50 SMA, reverse, taking out this prior high right here, which was literally a concern of mine, the 2763. The fact that we broke above this high right here, it just means to me that it's ready to continue higher, back at least into the 2800. And from the daily perspective, there is still this void. So we broke above this level right here at the 2755. This was my first concern area for literally for smaller time frame. And then the fact that we opened and pushed the price higher, I do still think we have a continuation all the way into the 2800. We don't have a lot of resistance moving forward. And I think this is what's going to push the market higher.
I like almost all of that. That was very, very well done. There's a lot of stuff on the radar this week, folks. At least from a fundamental point of view, we already got that. I'm saying the market goes higher. So we had a new home sales miss this morning. They were looking for 655. We got 593. The miss is good and bad. It's kind of Goldilocks here. The bad is that obviously new home sales are down. But the good is the fact that new home prices are up. So I know that forces people into rentals, but I'm not worried about the housing market. We'll actually get a better look into housing tomorrow, Tuesday, with the S&P Case Shiller. But look at tomorrow. We get durable goods and core durable goods. Whenever you see the word core, it means X something. In this case, it's X transportation items. So we get durable goods. The Fed skipper testifying. Trade balance, preliminary inventories, and this is a big one. Obviously, as you can see on the screen, the little red, what was that, flame or something? I don't know what it is. We get the Conference Board's consumer confidence number. That is a very big one. It's a big survey, too. It's 5,000 people. Hey, how you doing as far as your labor availability, your business conditions, and your overall economic situation? So that's a big one. Some China stuff tomorrow night that I keep an eye on. Wednesday, as Glenn alluded to, we get GDP. I don't think this one's going to be that market impactful, so to speak, because GDP comes out in three kinds: advanced, preliminary, and final. I mean, only the government gets to update their stuff 3 times, right? So the advanced usually has the biggest impact, but we'll watch that. Chicago PMI and then pending home sales. So we do get a good look into the housing market this week. Crude oil inventory tomorrow, or I'm sorry, Wednesday as well. Some inflation stuff that the Fed will be looking at later in the week is personal spending and personal income. You know, are we spending more? Are we making less? Are we making more, spending more? I always look at the numbers and to help me with my strategic mindset, and also some the final manufacturing PMI and construction spending. So then Friday we wrap it up with some University of Michigan numbers, consumer sentiment and inflation. So I think there's a lot of macro data here, but I really don't think it's going to rock this boat, so to speak. I'm not a big, hey, interest rates might go up. Yeah, I get the old Wall Streetism. When interest rates are high, stocks will die. When interest rates are low, stocks will grow. I think you need to put a little asterisk after that, because the Fed is looking to raise rates with what? With a little bit of confidence. So, you know, the Fed minutes last week, first of all, that Fed meeting was before the Trump, budget, and also before the market went full freak mode. So the minutes were pretty dovish, which is bullish for the economy. I mean, this guy, who was he?
Powell.
Powell, yeah. No. Before him, Greenspan. Was it when Greenspan raised interest rates? It was like literally, if you look back at it, it was a set of stairs. It went up, gently. If they're raising interest rates because of good things, the Fed under Janet Yellen, the old skipper, she's like, hey, we're at full employment, even though it's at 4.1. Not everybody can work or wants a job, to be honest with you. Some people just want to sit on the couch and eat Cheetos, right? So we're at full employment. The GDP smoking. There's a lot of good in the economy, and obviously, the tax cuts starting to melt into the economy. I think the Fed raising interest rates ain't necessarily a bad thing. I don't see any. If you want to jump out of this market to go, into a CD or a bond, I think you're smoking crack. Equities, in my opinion, are the place to be. So I think as we chop tactically through a lot of these reports, we might see some green shoots, some brown shoots. I laughed, I cried. It was better than cats. I'd see it again and again. I think the trend is up. As many of my members know, every pullback in the market in 2017, I can point to it on a chart and tell you what happened. It was political. From the president saying he was going to rain fire and fury on another sovereign country, to a Comey memo, to a failure of the Republican clown car to repeal Obamacare, you name it, it was all political. This, as we all know and have been discussing, was a short vol trade. So, and as you guys all know, this was an orderly pullback. I get if you just, came back from Elon Musk's, one of his ships and landed and you've been away for a while. That looks ugly. It actually wasn't when we were in it. It was orderly. There was no panic selling. And I got to be honest with you, some of the smart money I talked to during this, everybody was sitting there like, we wanted this, we needed it, and I'm bottom fishing. I can't wait until, we get the all clear. Now the all clear sounded, this was not the Fred Sanford. This was not the grab your chest and I'm coming, Elizabeth correction that everybody feel. I mean, last week it was a battle between BlackRock, the world's largest asset manager, saying everybody back in the pool, and Morgan Stanley kind of, I guess, saying what John was saying earlier, that, hey, man, that the main course is coming. This was just an appetizer. So I'm on the bullish side, and I'm Eeyore, man. I'm usually, this thing's going to zero, and the underlying fundamentals suck, but that's just not the case in my opinion. So anybody want to jump in on that before we go to question 4? John, Anka, Glenn?
Yeah, my view is we close up on the year between 10 to 20%. And any dips should be bought along the way. And of course, what we got this month was a dip with a turbocharger. We went to a rare 100% long position on February 9th, and it's paid off big time. The fact is that the fundamentals of the economy are strong and never justified the sort of move that we've had, the down 3,000 point move. So I believe the whole down move was bogus from the start and was a golden opportunity for those who didn't lose their nerve. It
was absolutely the biggest BTFD moment that we've seen in a while, and it was an orderly BTFD. So until we get, at least in my opinion, until we get a pullback like a no kidding earnings suck, or the Fed does something insane, which I don't think any of those things are going to happen. I mean, I was reading in the journal this morning, 78% of S&P 500 companies obliterated fourth quarter earnings, and we all know what the potential tax reform can do to
but that always
earnings per
happens
share.
They rig their earnings to be beaten. That's been a management technique for a long time.
Oh, I get it, man, but still, the average impact of the tax reform that I've researched is an average S&P increase in earnings per share of 8 to 10%. That is not insignificant. So I got my bull flag flying, and I think we go higher. So obviously this week, but also going forward. All right, David, can you scroll up to number 4 there? I think I don't have my report handy. It's on another tab. It's something about like the best trading system you've ever seen. What is it? All right, so John, maybe you can answer this, or we all will take a swing at it. Which do you think is best, trading one methodology or system all the time, or trading multiple strategies that adapt to the markets, and why?
Well, the only one that's ever worked over the long term is use fundamental research for your long-term calls and technical analysis for your short-term execution. If you look at the makeup of the hedge fund universe, there's never, ever been a technical analysis hedge fund. The answer is because technical analysis on a standalone basis doesn't make money over time. So that's what I use. That's what all major hedge funds use. It proves its worth over time, and I'm sticking with it.
That's my story, and I'm sticking to it. Glenn, what's your take on that one?
I missed the question again, Matt. What was the question? Is what methodology is most suited?
Just click on the little timing research tab down next to my smiling face there. It says, which do you think is best, trading one methodology or system all the time, or trading multiple strategies that adapt to the markets?
The latter, multiple, with the idea of looking for convergence. So I think John just said, in principle, in a macro sense, I agree. The fundamentals. And I'm hesitating because the technician part of my brain is revolting at what I'm about to say, and that is the fundamentals are the drivers. And then for the execution, look at the charts, the technical structure. Yeah, I don't actually do that because the type of I look at harmonics, and I really am a big cyclical analyst, and so I do believe, to the, I guess, contrary of many other participants in the market, that what has been shall be from a cyclical standpoint. So if I project cycles out into the future, I think I can get a good bead. Now, whether or not that's technical or quantitative or fundamental, I don't know. It's kind of a quasi area, a cycle. I don't know that it fits into a particular label, but I would agree, to the question, and a literal response, I would say, looking at the fundamentals and looking for agreement between that and the charts. So if that answers the question, yeah, I would just kind of coming back to what you were saying on the orderliness of the pullback on the previous question, Matt. Yeah, if I can, let me just, you clearly see it, and I had the S&P up before, but on the SPY or SPX.
We lost your chart if you want to bring it back up.
Oh, yeah. This is the SP. Where is it? Can you see it? This is SPY. A little different structure
than
a
pirate ship or something.
Oh, can you guys?
Or the Mayflower.
Yeah, that's our. I got to get a camera so that eventually you guys can see.
Yeah, I just can't. We just can't see your chart.
Okay, hold on. I might have. Let's try it again. Screen share. Share. And now, you see the chart?
I got it now.
Okay, so unlike the S&P, which had more or less of a double bottom, this is the SPY. To ditto your point, if this is the top, the January, I guess, 26 in the SPY, I had February 6. It was a bottom, not as critical, I guess, unlike in the S&P, but nevertheless, it was a bottom. But here's my point: if this is the top, and it's corresponding to a fifth wave in the context of an Elliott's description, here's what comes after a fifth wave. Here's your A, your B, your C, completing one cycle. Everything, and then by that reckoning, this is a wave 1. This would be a wave 2, and you've got a gap up today. Gaps are signs of strength technically. Again, this is even more of a bullish scenario evidenced in the SPY than it is in the ES. Because remember, in the ES chart, let me just quickly. It was a little different. The bottoms were more or less equal. You had a double bottom here. So, and that was the point I was making. This is like more or less almost equivalent. Here's the ultimate bottom on Feb 6. Then we had a secondary bottom just slightly higher at 2.9. And then this is wave 1, wave 2, wave 3, and a fifth wave, which isn't typically expected to be as powerful or as long as the third wave. But on the SPY, perfect order, to your point, coming down in that decline. Yeah. A, B, C. That fits in that model, at least theoretically. And then this makes it a 1. Now that's atypically short for a 2. Nevertheless, it can. And then that's just, and then this would make this a 3. Either case, qualitatively, I expect prices to go up. So I was just reverberating your point. Yeah.
Well, it makes sense. Yeah, that's part of that orderly pullback, is that, until the machines become self-aware, truly self-aware, and kill all of us, there's still humans involved. So that's
not till next year, by the way.
And John is long all of those companies. He probably knows which ones they are specifically. Anka, what's your answer to that question about different, trading methodologies or strategies?
I tend to stick with what technicals are telling me. There are two things here that I want to point out. First of all, I take it one day at a time. So I use very simple methodology, and I do look because I day trade and swing trade at the same time. It requires me to kind of differentiate myself from my swing trading from the day trading, because when you're day trading, you're literally almost looking at every single point in the market and every single tick, where you're swing trading, you have to distance yourself. So that's one of the reasons why I have to take a step back and put on my day trader hat in the morning, and then for the rest of the day, kind of like put my swing trading and active investor hat on. But I keep my methodology very simple. If it meets my buying the dip criteria, which we are in a very bull market, and this is what I'm going to be doing until it stops working. So for me, it is super simple because I keep a very simple trading plan. I'm buying all the dips into my key areas, and what I'm looking at is I'm looking at fit corrections. I'm looking at my very simple moving averages. So I'm looking at support resistance levels, obviously multiple support resistance levels throughout the chart, whether they're major or minor. So I look at very simple things from the chart, because trading does not have to be complicated. And I buy every single pullback in one of these key areas. And I think this is one of the things that kept me on the right side of the trade, and definitely not ignoring the trend. I don't have any issues. So I have been bullish for a very, very long time, for many, many years now. But I have no issue shorting this market. So right now, because we have been talking about the mini S&P, if it trades slightly below 2,700, I'm going to be short. So I have no hesitation to change my buying the dip strategy, and from going to a reverse. So basically, to answer this question, whether I use one methodology or system, yes, I do use one methodology or system. But I trade multiple strategies within the same system. So if the market provides, a bullish environment, yes, I'm going to be bullish. But if the market proves to reverse, I have no problem shorting. And in fact, you do make more money when you're on the short side than going to the long side. But if the technicals are there, I'm going to keep on buying the dip. And if it stops working one day, then I'm going to be on the short side.
But let me throw a caution out there to the average retail trader who isn't as good as Anka. I mean, you can shift your tactics in the drop of a hat when you see something like that. But being short, the short volatility trade for 2017 was easy and smart money and all that stuff until
Correct.
They all got destroyed last couple weeks ago. I mean, everybody was a genius shorting volatility until they're broke. So be very, very careful. I mean, Anka watches the market, and she can shuck and jive with it.
And one other thing that I wanted to mention, at these inflection points, definitely when the market was going lower, I had no problem buying the VIX. So I was hedging myself. I was hedging my decisions, and don't be afraid to do that. So don't be afraid to play around, because let's say if the SPX is going to trade below 2,700, I'm going to go long VIX again. So it's what you need to adapt with what the market is giving you.
Correct.
And most importantly, don't be afraid of the market, because you need to execute exactly what you see. If you have second thoughts about it, it means that you need to go back to the manuals. You need to go back into training, because you don't have the confidence to execute, and the confidence to execute comes from knowledge.
Mm-hmm. Well, and exactly, and like we kicked off with kind of making fun of the hedge fund performance, kind of year to date. If you take a look at Goldman's trading desk, I mean, you think Goldman's full of a bunch of bright people and the Death Star and stuff like that. Goldman had their worst year since 2004. So, they put their pants, their skirts, whatever they're wearing on the same way we do, folks. So don't think you're missing out on anything. As for me, the answer to that question is, my terminology is strategy's high level, is, it's 50,000 foot, it's win the war against ISIS, and then tactical is, guarding a bridge type of thing. So, financial strategy to me is, I don't know, managing risks, saving for retirement, income generation, saving for college. And then the tactics that I employ support that strategic mindset and are based on what's going on in the market. For the past, I don't know, 3-4 weeks, I've been doing bullish double verticals on volatility as we imploded. A double vertical is just simply two vertical option spreads on top of each other with the same strategic mindset. And then once kind of this all clear sounded, we've been doing bullish trades on volatility, or bear call spreads, for example, on VXX. So it's beautiful, beautiful trades. We knew that this the short vol trade was going to end. We just didn't know, or I didn't know, it was going to be that comical. And again, if you're going to do that type of trade, folks, short volatility, know that it's a great trade until it's not. So as probably everybody on this call can attest to, I know 3 or 4 people at large institutions whose entire portfolios were destroyed, and a couple of funds that have gone out of business with this, hey, this is an easy trade with a gently climbing market, and now we're broke. So be very, very careful with that, and always make sure you're hedged. Got about 6 minutes left, guys, and I always reserve kind of my own question at the end, because I know all the folks listening want something like this, so I'm going to pry one out of each one of you. So John, what's a good what's on your radar right now? A good tactical or long-term trade? What would give us a nice juicy trade that John Thomas is looking at? I think you're on mute there, John. Unless I've gone deaf, which is a distinct possibility. All right, now we got you.
Okay, can you hear that?
You bet.
Can you hear me now?
I got you. Go ahead.
The one stock we had the greatest confidence in rising over the long term was Apple. So when Apple got down to 150, we went very far, out of the money with a very long dated call spread. We did a 130, 140 call spread out to June. That was a bet the ranch type trade you could do with very low risk, very high returns. We get any kind of dips in the market in general, or Apple specifically, I would go back and put that exact same trade back on, although you may have to move the strikes up next time around to maybe a 140 or 150 next time around to get the same kind of income.
Okay, I like that. And John, I was just, I found this story for you. You'd like this. Rise of the Machines. AI apocalypse where robots take over and treat humans like guinea pigs could become a reality. This is in the Sun today. So very, very interesting technology. Maybe we'll do that on a different webinar. Glenn, what's a good trade? What do you like right now?
Sure. Any strategy that would establish short positions in the treasuries. I'm anticipating further weakness, significant weakness, and there are a couple of I'm happy to share just a quick, I won't spend too much here, just let me see if I can bring it in. Where's that? Okay. This is a 20-year monthly of the Treasury 30. Oh, can you see it?
No, not yet. We're still seeing the Flying Dutchman there.
Hold on. Yeah, I got to soon remedy that. So 1 second. By
the way, short treasury's been a core trade of ours since July. It's been like a rich uncle writing us a check every month for 7 months.
Yeah, and I anticipate persistence in that similar direction or trajectory. But let me get this so you guys can see. All right, let's try it again. Screen share, and to the charts now. All right, so up.
Nope, there you go. They're coming up.
I might have inadvertently deleted the chart that I wanted to. Bear with me. I'll bring it up real quick.
I'll tell you what. We'll move to Anka, and then we'll come back to you. So Anka,
yeah, okay, great.
What are you looking at right now?
Okay, so I do have, I'm going to share very, very quickly. In fact, everything just triggered today. So everything that was on my radar from last week, everything that was bullish, pretty much triggered. I'm just going to share the screen really quick. Okay, so I guess you guys can see it right now. I'm looking at XLF for long. As you can see here, I only have long positions. I'm looking at Pfizer over 36.70, Walmart over 98, back into a rotation. I'm looking to buy that dip in Walmart. Also, USO semiconductors, and these were from last week and this week that triggered. Nike, beautiful move today. Boeing, beautiful move as well. Continuation higher. MU was fantastic, and this was from last week. Google also participating this week. PayPal, eBay, these are all that triggered yesterday. And new watches, these were the new watches today. And as you can see here, Netflix 285, these were long positions that I would put on this morning that I had just put on. 285 for Netflix for my entry. NVIDIA at 246, SKX at $40, and AMAT at 57. These were my new watches, and they have all triggered. So I don't have anything else on my radar other than these trades that I'm already in, and these triggered this morning.
Yeah, that's a good looking radar, man. I like it.
Yeah, and as you can see, you know, it's very simple, and it's what I watch.
Okay, Glenn.
All right, let's try it again if I can get it to work. Share. And can we see the? I have a monthly bond 30-year Treasury up, and on the again, just using one particular model that I look at. This is the 20 years history of the 30-year. So this is the top here on the screen. I think is, and I interpret to be the end of a particular fifth wave, the bull market cycle, the 5 waves. And then you have the standard 3-wave ABC pattern. And there are 4 basic types. Without getting into that, this is the A, this is the B. Look at the date here. That's critical to the relative to the next chart I'm going to show. August of 2017, the high price coming in at 155 in 11. And then this is the C. I project the C is going to conservatively get you into the 133 to 130 area. How so? Because it should be, based on the model, equal in magnitude to the A. So that's just arithmetic. So even if I'm wrong on that and it's a malformed C wave, it's going to, you know, at least go 50%, a third of that. It's still a decent trade. And I think John said I've been short for the last couple of months here, and I still anticipate further declines. So that's the big picture, and the reason why, consistent with a daily chart. This is the daily chart, same data point here, 150, more or less, I think, a contract difference, but the high is 156 area. This data point right here, coming in September, is the same one we just looked at on the monthly chart. This is the C wave. This is the internals of the C, the 1, 2, and we're in a 3 of a C right now from a wave standpoint. We're at 144 and change. Again, I think there's a premium and a return to pick up between 144 and 130, you know, in that. So I like the shorts in any given, and that it also reconciles with what we're anticipating fundamentally, to the extent we start to see some increases scheduled for the year, 3 at least. That's going to work, you know, given the correlation. That, and in addition, any strategy that would embrace long positions in the U.S. currency, I think we're going to see a firming for the dollar as well. So, yeah, those would be my trades. But primarily the trade right now, we could even have a key reversal, depending on how things work out today, to good opportunity to go short with an option or the underlying, either way, depending on your money management stuff. Yeah. That's pretty much, did I lose you guys?
No, I got you, man. No, that sounds
okay. Good. Yeah, I lost my sound for a second. All right.
Nope. You're good to go. Okay. One of the gifts that just keeps on giving for us here over at Top Gun Options is Raytheon. About was it this other 2 earnings ago? whenever it was, Raytheon had a nice little pullback. This thing has, we're up triple digits. We put on a synthetic stock, or no, long call diagonal, a Jan 20 long call diagonal right about here. And then we've been trading front month bull put spreads on this thing, and it has just been absolutely nuts. Love the defense sector. The foreign military sales are going through the roof. I like a Raytheon over a Boeing, a Lockheed, a Northrop Grumman, a General Dynamics, any of those, because Raytheon, the one common theme that runs through all the names I just rattled off is a Raytheon. I sat behind a Raytheon radar for 15 years. Probably explains a lot of why I'm mental. But Raytheon runs in Boeing, General Dynamics, and everything. So we've been trading front month spreads on Raytheon, especially on this pullback here, right to the middle of this Keltner channel. And then this, I mean, take a look at a 2-year chart. Even under sequestration and President Obama, a Raytheon and the defense stocks did good. And then obviously Trump ain't no stranger to the military and wanting to spend money and blow things up. I think Raytheon, you get into a Jan 20 and you trade the front months on it, and it is a very, very solid defense stock. So, okay. All right, folks, I'll tell you what. John, how do we get a hold of you over at the Mad Hedge Fund Trader, and or get a hold of you?
www.madhedgefundtrader.com. Go to our website. There's a chance to sign up for some free research. We're averaging 34.9% a year in average annualized return for the past 10 years. And of course, I've been at the game a little short of 50 years myself. So long, short, macro, all asset classes, all the time.
Excellent. Awesome, John. Good seeing you, my friend. And Glenn, how do we get a hold of you and what you do over on the Pacific Trading Academy?
Sure. www.pacifictradingacademy.com. You can reach us. Again, we have a number of teachers and mentors and coaches. Specifically, I focus in on the technicals, anywhere working with traders just getting started. If you've been trading for any length of time, beginners, experts, anywhere in between. Again, on a basic technical analysis to more specific areas of technical analysis. My area of research is market timing and cyclical and Fourier analysis or harmonic analysis, to be particular. But if it's anything related to technical, that's what I love and that's what I teach. And for those interested in fundamentals, we have other coaches that focus on that. Ironically, I started my career as a fundamentalist, and the very first book I read, Fundamental Analysis by Benjamin Graham, struggled through it because, again, when I was 24, but when I began to incorporate a technical approach along with the fundamentals, I was more, for me personally, I was able to more consistently see the type of returns that I was looking for. So, yeah, that's what we do.
Awesome. Okay, man. Great time working with you. And Anka, how do we get a hold of you? What you do at Trade Out Loud?
Okay, so we have a special offer for our trading room. If you go to our website, it is tradeoutloud.com/VIP, and you can get access to the futures trading room where we call day trades and swing trades. We primarily focus on trading the first 2 hours in the morning. The room is open from 9 a.m. to 11 a.m. Eastern. And we give guidance for the rest of the day for trades. We basically focus on the minis, okay, NASDAQ, S&P, Dow, and Russell. We also call trades from the rest of the commodities, bonds, etc. And if you're interested in joining the room, we have a special offer. It is $49 for the first week, and then $199 for the continuation of the subscription. So if you want to join a trading room that is focused on the first 2 hours in the morning, we have a transparent track record. You can visit the 2017 is posted right here on our website, the portfolio results, which are amazing, but we have even more amazing results in 2018. If you want our track record for 2018, please email us at info@tradeoutloud.com. More than happy to send you a copy of that. We still have ongoing trades, and that's one of the reasons why it is not, because it is a real-time active sheet. It is not posted on the website, and that is for respect for our paying members. So it is tradeoutloud.com/VIP.
Awesome, Anka. And folks, real easy for me, topgunoptions.com. And we do live trade rooms throughout the week. If you want access just to our daily free video I do, and my rant today calling on the Scoured down here in Broward, our Broward, wonderful Broward Sheriff, Israel, awful man. But anyway, just go to our homepage here. We have beginner, intermediate, advanced. If you're a skier, you'll recognize that. We have accelerated retirement. We also trade the front months, and then we do some weekly options as well. We've having a blast. We on about 4,500 or $5,000 in risk last week. I think we made about $2,000 on an Amazon bull put spread weekly trade. I'm looking at maybe throwing another one on today as well. So if my members who are in the room here, I might send out a text alert here once we wrap up on that. But you can go to topgunoptions.com and find out everything we do there. So great time, folks. Good working with you again. And David, thanks for having me as the host. And I'll throw controls over back to you, my friend.
All right. Thanks, everyone. Great show. Just want to remind everyone watching, be sure to hit the YouTube subscribe button if you haven't yet to get updates on future shows. Also, be sure to join us tomorrow, February 27th. For Analyze Your Trade, episode number 25. That will be at the new time of 4:30 p.m. Eastern Time. Oliver Schmalholz, Christian Fromhertz, Neil Batho, and Dean Jenkins will be on that episode. And just want to thank all my guests again for today. John Thomas of MadHedgeFundTrader.com, Glenn Thompson of PacificTradingAcademy.com, Anka Metcalf of TradeOutLoud.com, and Matt Buckley of TopGunOptions.com. Thanks, everyone.
Thank you, David.
Thanks, David.